Hello, welcome to Business 100, Chapter 16. And here we're going to talk about, in this case, cash management. So, when you're managing current liabilities and current assets, one of the things we do, a business has to do is make sure they have enough cash on hand. Now, what we're going to do here is we're talking about working capital management. Okay, since short-term assets and liabilities continually flow through an organization, they are said to be working. So this is working capital. Okay, terms current and short run are used interchangeably. Current assets, and this is what we're going to be talking about in this lecture and maybe the next one because I'm trying to keep them short. The big one for today, or for this particular video, will be cash. We're going to manage cash, investments, accounts receivable, and inventory. Those are all current assets. Cash is going to be the one we're talking about here in this video. We also have current liabilities, accounts payable, accrued salaries, accrued taxes, and short-term bank loans. Okay, so when we're managing these current assets, the first one we talk about is cash. Okay, you have to remember, idle cash does not make money. Okay? Idle cash does not make money. If you have cash in a vault, in a drawer, in a mattress, doesn't make a penny. Okay? In fact, it loses value over time. But even if you have it in, say, a checking account, okay? Right now, the interest on checking accounts is next to nil. You might as well just put it in your mattress, but maybe it's safer in the bank. Okay? So idle cash does not make money. So managers try to just keep enough cash on hand to pay their bills. You want that golden mean. Okay? Just like in life, when you're managing cash, you want that golden mean. You don't want too much. Okay? Then you've got money that you don't need to pay bills for the firm. It's sitting idle. It's not gaining interest. We could be putting it to work somewhere else. Okay? So we don't want too much. We don't want too little. Because if you have too little, you don't pay your bills. And if you don't pay your bills, you go bankrupt. So we want just enough to pay our bills. If we could perfectly get the right amount of cash in a business, it would be just enough so that the cash came in, a bill comes in, the cash goes out, and the account's zero at the end of the night every night. And every night, every day, there's enough cash coming in to handle all the bills that have to go out that day, and they just keep going out. And any excess cash, we put to work. It's somewhere else. It's not in the bank account. Okay. Now, one of the ways to manage cash is to get your cash payments fast and pay your bills slow. All right? So these managers are trying to keep just enough cash on hand to pay bills. To cover what we call, and they do some transactions balances. Cash kept on hand by a firm to pay normal daily expenses such as employee wages and bills for supplies and utilities. Okay? These are our transactions balances. Okay? This is the money that you're going to typically put in your checking account, the business's checking account. Okay? So we've got money coming in and money going out. We want to get that money in as efficiently and as fast as we can. Okay? One of the ways that businesses do this is through what's called a lockbox. Okay? A lockbox is an address, usually a commercial bank, at which a company receives payments in order to speed collections from customers. I think at the beginning of the class I told you all I was a banker. One of the biggest headaches in my life when I was a banker was trying to deal with doctors. Okay? Doctors think they know everything. They're very smart. They might be good at treating the human body. But that is a completely different animal from a business. Because a business isn't an animal. Okay? Human beings are a rational animal. A business is not an animal. It's a business. Okay? A lot of times, each one of these different little doctor's offices I go to, they've got a clerk. Their only job is to take the money in that comes in the mail. So they run down to the post office. They collect all of the money in a PO box for the collections for the business, or it comes in and they sit around and wait for it to come in. They open the envelopes, then they go and they enter each one manually into the computer system to say, oh, John Smith paid $20 for co-pay on his account. Joe sent in $100 to pay for an X-ray, whatever, into these accounts manually. Then they take all the checks, they put them in a pile, they add them up, they're the cash calculator, okay? Then they take this big old pile of checks at the end of the night and they drive down to the bank and they deposit them in the night deposit. That's a whole employee, or at least a good portion of one employee that you're paying to do what a lockbox can do better, okay? These lock boxes usually have an express. When I worked for Wells Fargo, it had an express zip code, which meant your check got there probably about a day earlier than it would have gotten to the post office, in Auburn, Alabama, or wherever you are, and it goes straight to the bank, basically. These checks come in. They've got a machine that reads them. They've got someone that puts it in there, and they give you a file every day that has, here's all the payments you received and the account numbers that it went to. That file downloads, if you have the right software, it'll instantly adjust all of your customer records, and that money is already in the bank for you. Okay. That speeds up the bringing in this case, of cash. Okay. If we have cash, one of the things we want to do is we want to improve collections. We want to keep the money coming in fast. We don't want to wait for cash. All right? If we have extra cash, then we want to invest that cash. Okay? Now that lockbox option, that's one of the things we talked about. Another thing is card payment, accepting card payment. Okay, instead of getting a check, having to send it to the bank, having the bank read it, electronically transfer it to another bank, wait for the money to come in. Debit card, credit cards. Okay, that is another way of speeding up. Now with those services, you have to be careful. Some services are faster, some are slower. Some, it's easier for the customer to take money out after they've paid you. Some it's not. So typically, firms will also want to take this excess cash they have at the end of the day and invest it. Now, there's a video, I think it was in chapter 14, I had from Dave Ramsey. He said, don't get your investment products from a bank. For the most part, he's right. Okay? But one thing that banks do have for businesses is they oftentimes will have an account, and this isn't in your book, where at the end of the day, after all your deposits have been made and after all your checks have been cleared, it was called a sweep account. The bank will sweep that excess balance that you have out of your checking account, which gets none or very little interest, and will sweep it into something that gets a return. This could be anything from into money market accounts. It could be overseas accounts, okay? Euro dollar accounts oftentimes is one of the types of things you can sweep the money out into. Or it could be lending money overnight to another bank, okay? There's different types of sweep accounts. And if you have significant balances, if you're just starting off in a business and you got $20 at the end of the day every day, don't worry about $20. No one's going to mess with that. If you have tens of thousands, hundreds of thousands, millions of dollars in excess cash sitting in an account, okay, you'll want to plan and manage that yourself. But at the end of the day, if you didn't get it taken care of, okay, if you're not able to get that money out of the account for a significant period of time, these sweep accounts are another way of making a little bit of a return on your excess balances in the bank. We're going to get into some of these more better investments than that, but they didn't put sweep accounts on here, so I wanted to mention it. The bank will do it for you. Now, of course, the returns on those aren't necessarily all that high, and of course, the bank gets a cut because they're doing this for you. Okay. Things you can do with idle cash. Marketable securities, investments in U.S. Treasury bills, certificates of deposit, commercial paper, or Eurodollar accounts. Now, a lot of these, the bank, when I talked about that sweep account, the bank will do that for you. Okay? Or you can, through a finance department or a financial advisor or your bank or someone, can invest in these different options. The first one we have here is a T-bill. Treasury bills are short-term obligations of the Federal Reserve that can mature between 1 week and 1 year. These are considered to be the safest of all investments. They're considered to be risk-free because it is believed, because the federal government, the U.S. government, has a quasi-private central bank that can print as much money as the government needs to technically pay its bills, that these things will always be paid off. They are short-term debt obligations between 1 week and 1 year, and they're considered to be risk-free. The returns on these are going to be the lowest because if you remember earlier, we said risk and reward, right? High risk, high reward. Low risk, low reward. Okay. Here are some examples. Here are the safety levels. You've got U.S. Treasury bills, 90 days as an example, excellent. 180-day. Then we have commercial paper. Now, commercial paper are the short-term debt obligations for large, basically for large companies. They can be, these are usually companies that you know very well. They are using commercial paper to fund operations, daily operations, okay? They are unsecured. They're backed by the name of the institution, okay? So to give you an example, let's say Archer Daniel Midlands, which is a farming company and is very famous. They have a lot of products. They've been around for a long time. They've paid their debts. They've paid dividends. They might issue commercial paper, say, to pay for a planting in a field for corn. Okay, let me say, hey, we need to smooth out our cash flow. Okay, so we borrow money in the spring when we're planting, when we don't have a lot of cash and we have a lot of expenses. We then pay that back in the fall when we have a lot of money because we sell all of our corn and we have fewer expenses. So instead of paying for the corn early in the year, in spring, we'll finance that for, say, 6 to 8 months or however long it takes to grow corn. And then when the corn is sold, we'll pay off that commercial paper. Okay. And you can see here's an example, 30-day commercial paper issued by major corporations. Then we have certificates of deposit. They're also listed as very good in their safety level. A CD is where you lend the bank money. I know that sounds weird, but whenever you make a deposit, you are lending the bank money. They don't have it in a box. It's not sitting there waiting for you. Okay, that was discussed in chapter 15, especially the video I sent you on the Fed. But what happens here is you go to the bank. Say the banks give mortgages out, okay, a 30-year mortgage, and maybe they keep it on their books, okay, they didn't sell it. So they've got this 30-year mortgage. They had to buy the house, okay. Banks don't have any money. They have other people's money. The small sliver of money that they do have in the game is called capital. They're required through the banking system to hold certain amounts of capital. So when they lend you money, they lend you somebody else's money. And it's the best kind of money, somebody else's. I mean, would I rather make interest on my own money or somebody else's? It's somebody else's, right? So, because if it gets lost, the guy doesn't pay back. Hey, it's not my money. That was your money. Sorry. Okay. Now, that would come out of the bank's capital, but the banks hold just a sliver of capital compared to the number of deposits or obligations they have. Okay. Another way that the banks will fund, say, a mortgage is through a CD. And I'm just using a mortgage because everybody knows what that is. Okay, let's say you got a 30-year mortgage and it's a $100,000 house. Bank doesn't have any money. They got to use other people's money. So they might sell a $100,000 CD for, say, 180 days or a year. Okay, and then that's how they'll buy the house for you. So you're making payments to the bank. The bank is making interest payments on the CD. At the end of the year, the bank has to pay off that CD. So in order to keep funding your mortgage, they might have to go out, if they're funding them through CDs, they might have to go out and sell someone else a 1-year CD. Okay. Now the banks are FDIC insured, or many of them are. So even if the bank is bad at doing this, you still have a good chance of getting your money back. And then we have also something here, Euro dollars. We talked about that. Those are dollar deposits held in overseas banks. Okay. So we can manage current assets. We invest idle cash. We can invest them in CDs. These are available in minimum amounts of $100,000, maybe traded prior to maturity. Okay. Oops, there we go. Okay, those are commercial CDs. Those are sold by banks, typically finance companies, other types of things that you haven't heard of oftentimes. They don't really take deposits in through, say, checking accounts, or they do, but they don't, they're online banks sometimes. But any bank can do this. They'll issue a CD, but they do it through a market, through the money market. And those CDs are transferable, okay? Which means I go and I buy a CD from, say, I'm trying to think of one of the banks that sells a lot of them that you would hear of. I can't remember the name of the bank now off the top of my head, but there's one. Say, maybe I go and buy them from GMAC, which used to be a corporation. That's the bank I was trying to think of. It's GMAC turned into it. I can't remember the name. But GMAC doesn't really have a lot of depositors, but they do sell these marketable or commercial CDs. They'll sell these CDs on the market. Someone will buy it for $100,000. They'll finance your car with the money, buy the car from GM, and then as your payments come in, they'll pay interest on these CDs, and then at the end of a certain time, they'll pay them off. Okay. Commercial paper is a written promise to pay a specific amount of money. Okay. That is oftentimes issued by large corporations. GM, Ford, Chrysler might issue commercial paper. Archer Daniel Midland, General Electric. These are big, usually large corporations that have established track records of paying their bills, paying their debts, and making profits and having the cash flow to pay their bills. Okay? And then the euro dollar market, we talked about that. So that's where you're going to invest your idle cash. Managing accounts receivable. We're talking about these current assets. Accounts receivable is a current asset. It's important because many businesses make the majority of their sales on credit. Now, the key to credit is collect it. And to collect it as fast as you can. Okay? If we're selling a lot of stuff on credit to our customers, we want them to pay us on time or early. We don't want to wait. We don't want it to be late. Okay? So, one of the things you can do is you can establish discounts for early payment. Okay? So the terms of credit we give to our customers typically require customers to pay the full amount due within 30, 60, or even 90 days from the date of sale. You're not going to give out accounts receivable for long periods of time. Okay? And we may offer them incentives to pay off their balances early. Okay? Usually between 10 and 30 days. So we may say 90 days, we're giving you credit, but we'll give you a 2% discount if you paid off within 30 days. Okay? And that's because we want the cash flowing through the company, not the company waiting for the cash. We need it to pay our bills, we need it to pay our employees, we need it to buy supplies for the next bunch of sales things we're going to produce. Okay? Another way you can ensure payment on time is through late penalties. Okay? 1 or 1.5% to discourage slow payers from sitting on their bills forever. Remember, the same thing you're thinking, your customers are thinking. Would I rather pay you now or later? The answer is later. Okay? If I'm going to give you credit and say you can pay me later, that's fine. I want to give them an incentive to pay me sooner rather than later. Okay? If I give somebody 90-day credit and they're a slow payer, maybe they pay me off in 89.5 days or 90.5 days, or 91 or 92 or 93, I don't want to wait for the money. So I'm going to make you pay for being late. Okay? You say, I'll give you 90-day credit, but after that 90 days, you're going to pay 1.5% interest on that money because I don't want to wait late. I want it on time. I want it early. So I'll reward you for paying early. I'll give you a discount. I'll penalize you for paying late with a interest penalty. Oops, sorry. Okay, credit ratings provided by credit bureaus, credit rating agency, and industry trade groups. Okay. A lot of times, firms will try to generate profits by selling things to firms that are not good payers. Okay? Finding the right balance between the added advantages of early cash receipt and the disadvantages of reduced profits is no simple matter. Similarly, I'm reading from the book. Similarly, determining the optimal balance between the higher sales likely to result from extending credit to customers with less than sterling credit ratings and the higher bad debt losses likely to result from a more lenient credit policy is also challenging. So we can use these credit bureaus to establish a credit rating or an idea of how much risk we're taking when we extend sales on credit, whether it be to a consumer with a low credit score, right, FICO, or whether we're doing business-to-business transactions and we're extending credit to a new firm, okay, that has no established payment policy, or a firm that has not demonstrated the ability to pay their bills on time. Okay? So we can use these credit rating agencies to decide how much and if we should give credit to our business customers in this case. Okay? We can optimize inventory. Financial managers coordinate inventory purchases to manage our cash flows. Okay? Now, if you decide to get a bachelor's or something at some point, There are ways in which you can sort of plan out your purchases. Okay, there are models that you can use. Okay, we do not want to carry excess inventory. Again, just like with the cash, we want enough inventory to handle and be able to supply things to our customers as promised. But we don't want excess inventory that isn't going to sell. We obviously don't want too little inventory so that we can't meet our demands for our customers. So we've got to find a happy medium. Okay. Some firms will attempt to produce their goods just in time to meet sales demand. In this case, the level of inventory will be relatively low. If, on the other hand, the firm produces materials in a constant level pattern, inventory increases when sales decreases and decreases, when sales increase. One way companies manage finished good inventories is through RFID technology. There are also models that we don't get into here that can help you manage inventory purchases. Okay, and what type of a model or what type of a method you use is determined by the method of production. Okay, excess inventory, as we said before, just like excess cash, doesn't pay a return. Excess inventory ties up money unnecessarily that we could be investing in other ways to make returns on it. But inventory shortages could drive customers to competitors. So you're going to make sure you have enough, but not too much. Okay. Averting cash shortfall with short-term funds. So we talked about current assets. That's cash, marketable securities, accounts payable, and inventory. Now here we're talking about managing current liabilities. If we can, we want to stretch these out. We want our revenues, or accounts payable, or etc. fast. We can do that through a lockbox, through a good credit card, debit card system, depending on what type of business we are, lockboxes, billing, good billing department, good collections department. Those things can help speed cash flow up through the company. Here, with the accounts payable, we'd like to be on the other side of that. We'd like to stretch it out longer. Okay, so for accounts payable, we might want to take advantage or not take advantage of trade credit. That was that discount for early payment we talked about. Okay. Another way of managing current liabilities, bank loans. You can get a line of credit. The bank agrees to lend a specified amount of money upon request. So here, especially with a lot of small businesses that have might have cash flow issues, a line of credit is a nice blanket, safety blanket for them. Okay, this month maybe one of my customers doesn't pay. Okay, my big customers, he doesn't pay. How am I going to make payroll? How am I going to pay my bills? How am I going to pay my suppliers? Those types of things. A good way to deal with that is through a line of credit. So maybe the bank says, all right, we're going to give you a $100,000 line of credit, which means you can get up to $100,000 upon request that we'll lend to you and charge you interest on and all that other stuff. Okay? You can pay it all back. You can pay the minimum payment, and generally once a year on a line of credit, you want to zero it out. Okay? The bank likes to see that. If you're trying to grow a line of credit, you want to make sure you're zeroing it out at one point during the year. Okay, if I'm, say, Archer Daniel Midland and I get a line of credit, hey, I might want to run that up real high in the spring and then pay it off at harvest time. Okay, so I'm at zero. Okay. Another way of managing current liabilities is through secured loans. You can go ahead take out a loan is backed by collateral that the bank can claim. All right. Unsecured loans. You can borrow money that's backed by your reputation and credit rating. This would be for a company that's established or with an owner, say sole proprietorship or a partnership where you've got owners with good personal credit ratings. Okay. They might give you an unsecured loan backed by the signature of either the company's credit or the credit of an owner. Okay. When you borrow money, if you go to a commercial bank, they're pretty much only going to lend to prime customers, and you're going to get the prime rate. Okay, it's the interest rate that commercial banks charge their best customers, and they're going to base the rate that they charge off of that. Okay, interest rates may be fixed or variable. A lot of times with a line of credit, you're going to get a variable rate. With a secured loan or an unsecured loan, they might give you a fixed rate. Okay. Non-bank liabilities. Banks are not the only source of short-term funds for businesses. You can get it from other places. You can go through financial institutions such as insurance companies, pension funds, money market funds, etc. That can make short-term loans to an organization. The largest U.S. companies also actively engage in borrowing money from Eurodollar and commercial paper markets. Okay, these are all different ways in which you can manage cash flow in your business. Okay, here's one right here. Oops, my fault. This is something that a lot of firms think of doing. It's not your best option. Okay, and that is sell accounts receivable to a factor. I had a customer once. He was a good guy. It was a good business. He was having financing problems, so he sold his accounts receivable, in this case his credit card, basically his credit card receipts, to a factor. Okay, so they would lend him money, but then as his credit card receipts came in, they'd collect them until the loan was paid off. And then after that, they release what was left over to him. So for maybe, let's say a week out of let's say 3-4 days out of the month, instead of revenues coming in, is from credit card sales, it's going to this factor who lent him money. Then after 4 days, it's paid off or whatever, they stop taking his credit card receipts and let it go through to the company. You can factor your accounts receivable. The problem is that's money you had coming in. You're selling it to someone else at a discount. Okay? Say it was $100,000 that was going to come in 90 days. You sold it to a factor for $90,000. He makes 10 grand and you only get 90. But you don't have to wait for the money. Okay? Other non-bank liabilities are taxes owed to the government and wages owed to employees. These represent debt obligations, and financial managers must plan to meet them. So not only can you use these things to manage cash, they can also be siphoning cash away from the business later. All right? Thank you very much. Have a great day.